We don't keep our assets forever. We do eventually dispose of probably most of them. So let's talk about how you could dispose of assets. In general, there's 3 ways that we can dispose of them. You can sell them, you can junk them or scrap them or retire them. They're all the same thing. You just literally get rid of them. You don't get anything for them. Or you can exchange them. So I trade you, for instance, my truck for your piece of equipment. We're going to look at the first 2, though. We're going to look at scrapping or retiring, and we're also going to look at sales of assets. So let's get some information about our asset and work through a couple of examples. Let's assume that, let's look at a vehicle with an original cost of $60,000. Right, let's assume that it was purchased 2 years prior on June 1st. So we'll put purchased June 1, 2 years prior. Alright. The useful life was originally 5 years, and we were using straight line depreciation. So it's been 2 years, and we've just decided that we're going to junk or trash this. We're going to get rid of it. You're not going to get anything out of it. It's like you literally are going to go dump it off the side of, a ravine or something. I don't know. But we're getting rid of it. Okay? The first thing we do with any type of disposal, whether it's retirement, a scrap, or a sale, or even an exchange, I need to make sure that my depreciation is current. So I'm looking back, and I see that we have depreciated this for the full 2 years, but that's it. So the last time we did a depreciation entry was on May 31st, right? And now it is August the 1st, and we are going to trash this. So I need to catch up my depreciation. It's been 2 months, June and July, and I haven't depreciated that. So the first thing we need to do is actually make that depreciation entry. So we had an original cost here of the $60,000. So we can figure out our depreciation amount. That was, let's do this down here. We had, let's erase this. Original cost $60,000, and let's assume that we had no salvage value on this, and it was originally a useful life of 5 years. It was straight line, so that means we would have depreciated $12,000 per year. Well, I need to catch up 2 months worth of depreciation. So that 12,000 times 2/12 would give me a total of $2,000 that I need to now depreciate, catch up my depreciation. So first thing is we'd make our depreciation entry. So we've got depreciation expense. We're going to debit it for the $2,000, and we're going to credit accumulated depreciation for vehicles for $2,000. Now I'm up to date with my depreciation, and now I'm ready to dispose of the asset. So the next thing I do is actually the disposal. So think of what we're getting rid of. Well, yes, we are getting rid of a vehicle itself. But what accounts go along with vehicle? Well, there's the vehicle account. But what's contained within the vehicle account? We know we're going to involve that. Let's just make us a list. So the vehicle account. Well, we carry all of our assets at historic cost. So in the vehicle account right now, we've got that $60,000 cost. Well, that's going to go away if we get rid of the vehicle. What else do we have that's involved with the vehicle itself? You've got one other item to consider. You've got that related accumulated depreciation account for the vehicle. And what does it equal right now? Well, we had 2 full years of depreciation. So previously we had depreciated $12,000 for 2 years. So we had $24,000, and we just caught it up for 2 more months, that $2,000. So accumulated depreciation right now should equal $26,000 for this asset. So both of those items need to get off of our records. Neither one of them should stay because we're getting rid of the vehicle. So we don't need either of those accounts to be on our books anymore. Okay? So your book value at this time also is how much? You've got a $60,000 cost, $26,000 accumulated depreciation. So my book value is $34,000. Okay? So there's going to be something else involved here, right? Because you show a book value left over. Again, it doesn't mean that that's fair market value, but on paper, I don't equal. Okay? So for instance, let me just show you the makings of our journal entry. It's not going to be complete, but we need to take these things off. Vehicle has a debit balance. To remove it, I need to credit it. Accumulated depreciation has a credit balance, so to remove it, I need to debit it. So to start off with, we can do this. Accumulated depreciation, vehicle. We need to debit it for that $26,000 balance. And then you're going to have vehicle credited for the $60,000. Well, obviously, my journal entry does not balance. I'm not done. But there's nothing else involved here. I didn't get cash for this. I just threw it away. I'm done with it. Bye-bye, adios, rolled it down the hill. Well, since on paper we still have a book value associated with this, then the difference here in that book value we have to account for somehow. And we're going to account for that with an account called loss on disposal. Now I balance. It just shows me the remaining book value that has not yet been depreciated. This could be because it's, again, in the middle of its useful life like this. It could be that it was a fully depreciated asset, but we had a salvage value. So that would be the value of the salvage or residual amount. So this is going to be an account that shows up on your income statement. Loss, it's a type of income statement account. Gains and losses. It operates in much the same way as an expense account, but it is a loss account. It's a separate type of income statement account. Gains are kind of like revenues, but their gains they're a little bit different. Okay? Well, let's say that instead of just scrapping it, throwing it away, getting rid of it, let's say that, same example, same asset, but now I'm going to sell it. All right? So remember those numbers. But now, let's say that we sell it for $40,000. So you say, hey, I don't really want this vehicle anymore. We're going to get rid of it. But got somebody that says, hey, I'm interested in it. I'll buy it from you for $40,000. Great. We know we're going to get some cash. So let's go ahead and record that. We're going to debit cash for $40,000 because I really am getting cash. But I'm really getting rid of the vehicle. So the same things we talked about before that are tied in with the vehicle, I need to get rid of. So there's that accumulated depreciation account that needs to go away for $26,000. Because remember, now I'm not doing this separately again, but the first thing I would do if I was selling this instead of retiring or scrapping this, I would still need to make that entry to update or catch up the depreciation. So we'd still need to make that $2,000 adjustment for depreciation to get that $26,000 accumulated depreciation up to date. Okay, so I'm assuming we've already done that. All right, and then we also have the vehicle account itself with the $60,000 cost in there. Hang on, go back. There we go. Flip the page there. Okay, but do we balance? Does my journal entry balance? No, I've got $66,000 in debits and I only have $60,000 in credits. Why? Well, you can easily see that I need a $6,000 credit to make this balance. Okay? But let's put some sense behind it. I sold this vehicle for $40,000. What was my book value? Well, we had $60,000 in cost and we had accumulated depreciation of $26,000. So my book value equaled $34,000. On paper, it looks like I have a value of $34 and I sell it for $40. So as far as the paper is concerned, again, book value does not equal fair market value, obviously, because we sold it for $40,000. But this looks like a benefit for me because it looks like it was only valued at $34. I sold it for $40. So this is a gain to me. I'm going to write gain on sale. This is technically gain on sale of fixed asset, but I'm just going to shorten that a bit. Gain on sale. Give you another instance. What if we had the same scenario, but now instead of selling it for $40,000, let's assume we sell it for $30,000. So this time we get cash, but we only get $30,000 this time. We still have to take that accumulated depreciation account off because we're not going to have the vehicle anymore. We're giving that up. And now we have the vehicle account itself at $60,000, but I do not equal. This journal entry does not balance. We've got a $56,000 debit and a $60,000 credit. This time to balance out, I need $4,000 in some kind of a debit. Again, remember book value right here, $34,000, but I only sold this for $30,000. So on paper, at least, it looks like I didn't do so hot. This is a loss. Loss on sale of fixed asset, $4,000.